Good afternoon, and thank you for joining us for Tax Basics for Creatives, presented by Elaine Grogan-Luttrell with Minerva Financial Arts. I am Lisa Smalls, Director of Arts Access and Learning at South Arts, and I'm joined by my colleagues Hillary Crawford and Helena Haile Selassie. I am an African American woman with long, black curly hair, wearing blue glasses with multicolored specs, and a brown textured sweater. Before we begin, I'd like to offer some helpful tips for today's session. To turn on captions, click the Show Captions button in the meeting controls. If needed, choose the language for the captions if it's different from the default. Please place all questions in the Q&A pod. We want to reserve the chat for interaction with the slides and for conversation and connection with the group. A recording of today's webinar will be housed on the South Arts website in our resources section, and all registrants will also receive the link and today's presentation materials via email. Lastly, please use the link in the chat to complete a brief survey to help us better serve the field's needs and interests. I'd also like to acknowledge our partners at the NEA. South Arts empowers artists and arts administrators by expanding access to professional development opportunities. Our free Arts Admin Essentials webinar series offers timely, topic-driven sessions that respond to the evolving needs of the field, providing practical tools, insights, and industry best practices. South Arts receives support from the National Endowment for the Arts through a partnership agreement to produce webinars such as these and conduct additional programs for our constituents across the region. Please visit our website as well as the NEA's website for additional information and opportunities. And with that, I turn it over to you, Elaine.
Thank you so much, Lisa. Hello, everyone, and welcome to today's conversation on tax basics for creative individuals. Huge thanks to Lisa and her entire team at South Arts for supporting these conversations. They are so crucial to happen as we go through some really complicated tax things in this particular tax year, indeed. So we are recording this for the 2026 edition of this tax conversation. Most of the content will talk about filing the taxes for the 2025 tax year because that is the season we are in. Our goal today is to make navigating tax season this year a little bit easier for you, but also your tax life overall, right? I don't know if you watched the Super Bowl commercial with Adrian Brody, but he made the comment that in life, death and taxes are the certainties, but death only happens once and taxes happen every single year. So with that in mind, we want to keep your tax life easy or as easy as possible going forward. More specifically, we'll start by covering some new tax things for this particular filing season. We'll also talk about the overall income tax landscape, and we'll talk about ordinary and necessary business expenses that you can claim to offset your business income. We'll also talk about record-keeping systems and some strategies that might help you on an ongoing basis. As Lisa said, my name is Elaine. I use she, her pronouns, and I am joining you from Dublin, Ohio today, which is Kaskaskia and Hopewell Indigenous and Cultural Lands. I am a middle-aged white woman with long, wavy brown hair, and I am wearing a cream top and a black jacket today. I am a CPA by training, and I hold a personal financial specialist designation from the AICPA, and I'm an accredited financial counselor. All of those things enable me to work with creative individuals and organizations across the country, including groups like South Arts, to support creative individuals with the business and financial side of their creativity. I also work with a handful of colleges and universities and their students and alumni because I do not think you can hear this information often enough. We come to this information at different times in our careers, and sometimes new information lands differently depending on where we are. As we go through today's conversation, please take the space you need to make sure your questions are answered. As Lisa mentioned, we're using the Q&A feature to organize and gather questions, and we'll be addressing them throughout the presentation. I would also encourage you to make space for others to share their questions and comments as well. Additionally, we are all equal parts teachers and learners in this space. You are bringing your own experience and expertise to this conversation. And if you have resources to share or software platforms you love or a CPA you've been working with that really knows and understands the arts, please share resources like that in the chat. We all benefit from the collective wisdom in this particular group. And lastly, although this is being recorded, we do ask that stories that might be shared stay here within the space. But by all means, please take the lessons from those stories and carry them with you. My last bit of housekeeping, although I am a CPA, it's important to note that I am not giving you tax, legal, or accounting advice today. All of this information is being provided in an educational context, but I hope it's still useful to you. So let's start out by highlighting some of the new things for this particular tax year. For 2025, we had an increase in the standard deduction amounts that folks claim on their Form 1040. Now, generally, these amounts go up each year. What's special about 2025 is because of the mid-year tax legislation, these amounts went up even more. Additionally, if you or someone you love is age 65 or older, there is an additional standard deduction amount that they are eligible to claim, which will reduce their taxable income even further. These standard deduction amounts are set based on your filing status. So a single taxpayer would have a $15,750 standard deduction amount, while someone who is married filing jointly with their spouse would have twice that amount. The other change for the year has to do with the tax brackets. These tax brackets generally increase slightly from year to year, and they are applied to your taxable income. So when we're thinking about taxes, we basically report our income, then we reduce our income by lots of different deductions and adjustments, and then the resulting amount is our taxable income. That's the amount you pay income tax on, and the tax brackets for single taxpayers and married filing jointly taxpayers are here on the screen. We do have a progressive tax system, which means as your income goes up, the tax rate you pay on those higher levels of income goes up as well. We also had small changes to the retirement contribution limits. For 2025, if you made or plan to make a contribution to your individual retirement account, the cap for what you can contribute is $7,000 or $8,000 if you're age 50 or older. And if you're planning for 2026 contributions, you should know that that amount is going up slightly this year to $7,500. And remember, you have until tax day to make contributions to an IRA and have the contribution count for 2025. So if you are looking for additional deductions, you might consider a traditional IRA contribution. Or if you find yourself in a relatively low tax bracket for 2025, but you have earned income and some additional cash available, you might think about making a Roth contribution. There are also a number of new deductions that came up in 2025 as a result of that mid-year tax legislation. The first one is commonly called no tax on tips, but I've been modifying it to talk about it being no income tax on reported tips, which captures a little bit more of the nuance behind this change. So here's how it works. If you are someone who is customarily a tipped employee, so maybe someone in the service industry, or maybe you are a creative person who does some busking or performs where there is a sort of tipped environment, or maybe you have a digital content creation platform where you do receive tips in that sort of capacity. Those all count as customarily tipped occupations in the eyes of the IRS. The IRS has shared a list of what some of these occupations are. It's pretty extensive, and I would direct you to the entertainment and events category to see if your creative practice qualifies. You can't simply take your income and classify it as tips. It has to really be sort of a customarily tipped type of amount. But if those amounts were paid to you and if they were voluntary, they can't be required tips in any sort of way. And if you report those tips as income, you would then pay Social Security and Medicare tax on those tips. But if you report them as income and pay your Social Security and Medicare, and then your total income is less than $150,000, which is a pretty generous limit, then you are eligible to claim a deduction to reduce your taxable income by that tipped amount up to $25,000 per return. Right? So let's pretend you are a server and you work at a high-end restaurant, and the restaurant sends you a W-2, and the W-2 includes your tips for the year. You're already paying Social Security and Medicare on that amount. As long as your total income is less than $150,000, you would be able to deduct the amount of tips. So it's slightly more complicated than simply no tax on tips, but if this applies to you, it is a nice deduction that you can take advantage of starting in 2025. All of this is captured on a brand new form that's been added to our tax packet for the year called Schedule 1A. Similarly, there was another provision of that legislation that introduced no tax on overtime. And again, this is no income tax on overtime. So if you are an exempt worker under the Fair Labor Standards Act, meaning you're not eligible for overtime, this is not something you can claim. But if you are eligible for overtime compensation and you receive overtime compensation during the year, we report all of that as income, and it's earned income, so you're paying Social Security and Medicare on it. And then you may deduct the overtime portion of your pay. So we think of this as perhaps you're paid time and a half. So if your standard hourly rate is $20 per hour and your overtime rate is $30 per hour because you get time and a half for overtime, your deduction would be that extra $10 for any overtime hours, right? So we report all the income, and then there's this additional deduction you can claim for the overtime portion of any compensation you receive. In a perfect world, the overtime would be reported to you. You might work with your employer to see if they can sort of identify exactly what that amount is. And this deduction is up to $12,500 per person. There's also a new deduction for folks who have car loans, and the loan had to start in 2025. So it's a relatively new car loan, and the car you purchase had to be manufactured or at least finished being manufactured in the United States. And a way to check that is to look up the car's vehicle identification number, its VIN, on the NHTSA website, and that'll give you the manufacturing information. What's nice about this is if you qualify, right, and you paid interest, you may claim that interest as a deduction up to $10,000 on that loan. The lender will probably send you a form identifying what this interest amount was, and you can use that to help claim your deduction. This is relatively new, though, so it is possible the lenders may not be fully on top of reporting. So if you think you qualify for this, definitely dig into your own numbers to see if you can calculate what your deduction might be. And then lastly, there was a new provision in the legislation called no tax on Social Security. And again, it's kind of no tax on Social Security. If you are someone who is receiving Social Security, you still report the Social Security income as you always would, right? And then you are eligible to claim this enhanced deduction for seniors, for anyone who is over the age of 65. And that additional deduction is $6,000. So like with these other deductions, like the no tax on tips and no tax on overtime, we still report the income, and then we claim the deduction to reduce our overall taxable income. So if that applies to you, or if any of those new deductions apply to you, make sure you're capturing them. They will all be on that new Schedule 1A. The other changes that might impact some of you have to do with deductions for your state and local income taxes. If you've been filing taxes for a minute, you know that when you itemize your deductions, the amount you can deduct for your state and local taxes, so that would be income taxes to your state, any income taxes to a city you might live in, and any property taxes, that deduction has been capped at $10,000 since 2018, more or less. Now, the increase or that cap has been increased to $40,000. So if you are someone who lives in a relatively high tax state or jurisdiction, or if you pay a lot in property taxes, you might find yourself having a larger state and local tax deduction than you otherwise would have had over the past couple of years. Now, what that means is we might have more individuals that are choosing to itemize their deductions on their tax form rather than claiming the standard deduction. That's totally fine. But if you've been in the habit of claiming the standard deduction, you might want to go ahead and just double check the math this year to make sure you're not accidentally leaving additional deductions on the table. This new cap will be in effect for the next handful of years, officially through 2029, and it is set to go up annually. So this might continue to benefit you if you live in those high tax jurisdictions. I will also share two new things that are not new for 2025, right? These things will be new for 2026 going forward. So if you are someone who will be itemizing your deductions in 2026 or beyond, there is a charitable contribution deduction that's captured on Schedule A. Your charitable contributions have to exceed 0.5% of your adjusted gross income. So not all of them may count, but most of them probably will. So just be aware of that. But if you are someone who will be taking this standard deduction, we have a new deduction starting in 2026. This doesn't matter for 2025, but it will matter for 2026. Even if you take the standard deduction, there's going to be an extra deduction you may claim on top of the standard deduction for charitable contributions you make during the year. It's up to $1,000 for single taxpayers or $2,000 for those who are married filing jointly. So if you are naturally charitably inclined, you may get an additional tax benefit for that starting in 2026, even if you don't itemize your deductions. My last piece of good news, again, is not for 2025, but it is for 2026. The threshold for when an organization or company needs to send you a 1099 reporting the income they paid to you is going up. It has been $600 for a very long time, and starting in 2026, the new threshold will be $2,000. So if you are sitting on a very large stack of 1099s from 2025, the good news is you might get fewer 1099s starting in 2026 because that threshold is going up from $600 to $2,000. Now, a quick reminder, this threshold is only a reporting threshold, right? So it's for the organization to send the form to you above this threshold. It is still your obligation to report all of your income, even if it's less than that threshold, right? That still counts as taxable income to you. You'll just get fewer sheets of paper going forward. I know that's a lot of new things, right? And some pretty major changes. So I'd love to pause here and just check in with Lisa and our Q&A to see if there are questions that have come in that it might make sense for me to address at this moment.
There are no questions at this time, Elaine. However, if they come in, I will let you know.
Amazing. Thank you so much, Lisa. I appreciate it. As a reminder, don't be shy to put those questions in the Q&A because we will definitely take time to make sure your questions are answered. So now that you know what's new, let's take a step back and just think about sort of how federal income taxes work. In general, individuals who are permanent residents, dual citizens, or US citizens all file Form 1040 in the United States to report their income and pay their taxes each year. If you fall in a different category, maybe you're a non-resident, your form would be Form 1040-NR. And the IRS has some great guidance on its website for folks that fall into different categories. But mostly, permanent residents, dual citizens, and US citizens are filing Form 1040. And Form 1040 starts out with some information about you, the individual, and then it shows all of your income from various sources. And we know in the arts, you might have a lot of different sources of income. And then we reduce that income for adjustments and the standard deduction to get taxable income. And this taxable income number, after we've reduced all of your income for all of those adjustments and deductions, is what you pay income tax on. So just at a very high level, that's how Form 1040 works in the United States. And what's helpful to think about is to kind of understand for your own situation, how are you earning income? Because different income gets reported in different places on your tax form, and there might be different taxes you need to pay on it depending on what type of income it is. It's also important to understand what records you need to keep, particularly as a business owner. And as a business owner, it's important to understand what is deductible for your creative business. It's also important to understand what makes taxable income go down, right? Even if you are not running a business, there are still opportunities for these adjustments and deductions on your personal tax return. And then lastly, once we kind of know all this, how are you supposed to use it to plan for your tax obligations going forward? So let's start with the type of income you have and specifically why it matters. In the arts, generally, we have income that falls into three different categories. If you have a job as an employee where you work for someone else, you are receiving wages from that employer, and they are reporting those wages to you on something called Form W-2, right? You are an employee of someone else and you receive wages. This could be any number of different jobs. If you're a performer and you are performing under an equity contract, you are probably paid as an employee. If you have an arts administration type of job and you are paid as an employee, that counts. Or maybe you have any other type of job where you are paid as an employee, right? Those are W-2 wages. They get reported on your Form 1040. It's also possible you have other types of income that I'm broadly calling business income. Business income is related to any sort of creative business you are running. Sometimes this income is reported to you on a Form 1099, but sometimes it's not. If you are making sales or providing services directly to collectors or customers, they might not be sending you a 1099. It's your obligation just to keep track of that information, right, in your own books and records. And it's also possible you have what we broadly call other income. Certainly, if you have a creative activity that you are pursuing just for fun, almost like a hobby, instead of as a business, that income would be reported as hobby income. Or if you have a high yield savings account or investment income, that type of income would be reported as other income as well. But if we drill down a little bit more into the distinction between W-2 income and business income, what I want you to know, or what I want you to remember, because you probably already know some of this, is that if you're an employee of someone else, they will be withholding taxes from every payment they make to you. Those taxes include your Social Security and Medicare. And by the way, your employer is paying half of those taxes for you. And then it also probably includes federal and maybe state and local taxes as well. And if you are an employee of someone else, you are not allowed to claim business deductions to reduce your wages from that employer. Why? Because it's not your business, right? You can only claim business deductions if it is a business that you are running, right? If it's an expense that you happen to have while you're working for someone else, that is not generally deductible. But if you are running a business, not only are there no withholdings, right? If you send an invoice and collect the payment, there will be the full amount you receive. but you are responsible for calculating and paying your own taxes on that income. However, as part of that calculation, you are allowed to claim business deductions. Why? Because if you are running a business, you are able to claim business deductions to reduce the taxable income from that business. So, withholdings, shared tax obligations, no deductions, all that applies to wages or W-2 income. Running a business, claiming deductions, but also paying your own taxes all associates with business income. So let's take a moment to talk a little bit more about what it looks like to be running a business. In the eyes of the IRS, there's a handful of sort of criteria they are looking for. They want you to be approaching the business or the activity professionally and keeping books and records. In the eyes of the IRS, that means income and expenses, but there might be a lot of other types of records you have as well. Maybe you have customer logs, or maybe you keep track of your inventory or exhibition history, or maybe you are keeping track of different grants or shows or programs you are applying to, right? All of those sort of indicate you are approaching an activity professionally and keeping books and records. The IRS would also make sure you are spending enough time on your business to make it profitable. What we're looking for here is making sure that you are sort of regularly conducting this activity. It doesn't have to be full-time or full year, depending on your creative pursuit. But if you are doing kind of one thing once that you're getting paid for during the year, that's probably not enough to rise to the level of running a business. It's also important that you have the knowledge needed to make the business successful. And it's fantastic if you are making money from the business. It's even better if you are making a lot of money from the business. But what we really want is to make sure that you do intend to make money from it. We want there to be some sort of profit motive associated with this activity. We know in the arts, making money might not be your primary motivator, but to be running a business, you have to intend to make money from the activity as opposed to doing it as a hobby or just for fun. I will note as well, though, there are years where your business might not be profitable, and that is okay. The IRS has what they call a rebuttable presumption, and they will assume you are a business if you are profitable in 3 out of every 5 years. So that means the money you're bringing into your creative business is more than the money you are spending on that creative business in 3 out of every 5 years. Now, if that's not the case for you, that's okay. You just might be asked to demonstrate or show evidence that you are, in fact, attempting to make money from it. You are keeping books and records, and you are spending enough time on it to make it profitable, and you are knowledgeable enough about this business. So because these books and records are so important, let's sort of lean in to talking about sort of what this looks like, right? So in the eyes of the IRS, you can use any system suited to your needs as long as it shows your income and expenses. So that gives you a lot of room to find a system that really is going to work best for you. It also allows you to know how you work best and then find a system that complements that rather than forcing you into a system that might not really make sense with your own preferences and habits or your own business style. But no matter what type of system you use, it's important that you track 4 key pieces of information associated with each transaction. You need to know the date of the transaction, the counterparty, so who did you pay in the case of an expense, or who paid you in the case of income, the amount of the transaction, and the business purpose. And so the date and the counterparty and the amount are going to be captured on the receipt or your credit card statement or your bank statement, right? That information is relatively easy to track. But it's that business purpose that is important to document for any income or expenses associated with your business. because that essentially describes why this particular expense is a business expense instead of a personal expense. The IRS has a publication called 583, Starting a Business and Keeping Records. It's a fantastic resource for kind of describing some of the record keeping requirements for running a business. And it's a helpful resource if you haven't looked at it in a while. So you can keep this information, as I mentioned, in any type of way, including an analog way with paper and a ledger, and that is absolutely fine. Might not be the most efficient, but if that's how you work best, that is totally fine. You can also consider using a database system. This is something like Excel or Google Sheets or Numbers. And these are very powerful tools that you can use to organize and track your information. You can type the information in yourself, or you can export it from your bank account or credit card so that the information is all in one place. And then you can organize the information, add it up, use it to make budgets or forecasts. You can do a lot with the information once it's there. A database system can be great for someone who maybe is just starting out or looking for some accessible and relatively inexpensive tools to use. And for someone who really wants some control over how they're tracking their income and expenses. Something like Excel or Google Sheets is very, very customizable in a way that sometimes the software platforms aren't. So if you can get comfortable with the tools and you're comfortable sort of using them, then it can be a really great way to track your income and expenses. What Excel and Google Sheets can't do is send out invoices or receive credit card payments, right? So if something like that is important to your business, then you'll probably want to use some sort of system that allows you to do that. But some folks don't necessarily need that for their creative practices. If you're curious about setting something up in Excel or Google Sheets, this is probably how I would set it up. And you are welcome to access this template and save a copy of it to your own Google Drive if it would be helpful to you. The way this is organized is it has the date, the vendor or the client, the amount, and the business purpose captured for each transaction. Not coincidentally, that's the required information that you need to keep, right? So it's all going to be captured there, either by exporting the data or typing it in. I've also added a column called category, and this can help you sort of organize the expenses so that you can track them into different categories, which will make it easier to see the information in summary form instead of looking at every single transaction throughout the year. If you'd like to take a peek to see what this template looks like, it is linked on the slide and you are welcome to access it or use it later. It starts with sort of a welcome sheet that explains how to use it, but most of the work happens on this detail tab. This is where you would enter the information and choose the category for each expense. So let's pretend I'm going to report $150 of royalties in a particular year or a month. I would import that information or type it in. And once it's there on this summary page, it will then automatically add up anything in these categories so that you can see the total information instead of looking at it sort of line by line. This can be really helpful if you're navigating a lot of different transactions. And again, you are welcome to use this. I will note, though, this is designed for lots of different types of creative businesses. So once you save a copy to your own drive, customize it. You know what categories make the most sense for you and your practice. So don't be afraid to sort of tweak this and make it really work for you. You are welcome to use it if it is helpful for you. Within this template as well, there's also a mileage log. If you are someone that uses your personal vehicle for business purposes, you can keep track of the business miles you have driven and then claim a tax deduction for those miles. The rate is 70 cents per business mile driven, and that is meant to cover car maintenance and gas and other sort of expenses associated with your vehicle. You do have to keep a written log of those business miles driven, and you can do it in something like Excel or Google Sheets or a notebook in your car or an app that might automatically track those miles for you as well. All really great options, but it can be helpful to keep everything in one spot. So if Google Sheets or Excel is going to work for you, go nuts and have fun. If you say, Elaine, there is no way I'm going to take as much joy in Google Sheets or Excel as you do, that's okay. There are a ton of different software options that can help you keep track of your income and expenses as well. And I will say, not a single one of these is perfect. I work with people who use all sorts of different software systems, and some people love them for different reasons, right? There's no one single system that is absolutely the best for everyone. So, again, know yourself and know how you like to work, and then find a system that will work for you. For these software systems, the ones I've shared here, some of them are personal financial tracking systems, and some of them are more business financial tracking systems. Sometimes artists and creative individuals, especially if they're sole proprietors, find it easiest to use a personal financial system and just add some categories to help them track and capture their business expenses. That's okay. If you are someone, though, that has an LLC or an S corporation, or even someone who likes a little bit more separation, you might be more drawn to one of the business financial tracking systems. That is also okay. Know yourself and know how you work best. Simplify, Empower, and Rocket Money tend to be some of the most common personal financial platforms. QuickBooks, Wave, and FreshBooks, and Xero as well are great business financial tracking options. Wave has a free version and also a paid version, and Rocket Money also has a free version as well. So if you are someone who maybe doesn't necessarily have the additional income to spend on something like QuickBooks that runs closer to $30 a month, that might also help identify some other options that work for you and your business. I've also included two more on here, My Music Staff and Honeybook. Both of these have some income and expense tracking options, but they both operate more as like customer tracking tools. Honeybook was originally designed for wedding photographers and videographers, so it has a really wonderful sort of contracting, customer-facing portal in addition to the income and expense tracking. My Music Staff was originally designed for musicians who have teaching practices, right? So don't be afraid to sort of explore some of these other options that might make sense for you. You might be someone who's more drawn to these software platforms if you want the integration of sort of automating the data input. All of the software platforms basically work the same. They connect to your bank account or your credit card, they import the data, and then there's a level of machine learning that goes on where they attempt to categorize the transactions based on your history and also the changes you might make. So it can be a more efficient way to track your income and expenses. Whereas in Excel or Google Sheets, there's a little bit more manual processing involved to categorize things. There are still ways to do it efficiently, but it's not quite as seamless or fast as some of the software programs. Or if you are someone who needs those additional features, like sending invoices or receiving payments directly from customers, it can be really nice to have a software platform that will enable you to do that instead of trying to use a bunch of different options. This is also often better for someone who has that separation, but as I mentioned, there are personal software platforms that can work on both. And often there is some sort of financial investment required with these systems, but there are some options that are free as well. But no matter what type of system you are using, you're going to want to make sure you are keeping your records for a 7-year period. And we get to that 7-year period because the statute of limitations, the amount of time that the IRS has to examine your tax return and ask questions about it, goes for 6 years. The normal statute is 3 years, but it can be extended to 6. So we generally assume or plan for it to be to 6 years. but it doesn't start until the later of when you file your tax return or your tax return is due. That's how we get to 7 years. We have the year when the transaction happens and then 6 years after that, right? So if you are keeping track, this means you will be saving all of your receipts and expenses and records and everything all the way through 2032, which is long enough to cover that 7 year period. I generally suggest as a best practice for folks to set aside a little bit of time, maybe every month or maybe every quarter, to update your system, your books and records. Sometimes it's easier to do this in sort of a batched transaction approach instead of sort of one at a time. So doing this, updating your numbers once a month or once a quarter can be a really good way to stay on top of things. It's also a good way just to keep an eye on your business throughout the year so that you know sort of how things are going, or if someone is maybe late on paying you or something, right? Or to help inform your future decisions about whether it makes sense to say no to a future project because you're in really good financial shape this year, or if it makes sense to maybe invest in a new system or a new expense that you've maybe been dreaming of because you have a little bit of room in your books. So stay on top of it so that you're not saving it all for the end of the year if you can. I will say though, a monthly and quarterly rhythm might not work for you. I do have a handful of folks I work with who update their books twice a year, once in June or July, and then once in December or January. That is totally fine if that works for you. I do it a little bit more often, but it's your business, so you get to decide. I also have folks who don't really work on a monthly or quarterly kind of basis. A touring musician, for example, might find it really hard to update numbers once a month if she's traveling all over the country and not necessarily in a place where she can do administrative work, right? So that's okay. You can set up your rhythm to update your books at the end of each tour, maybe, or following a period where you are able to be at home for a week or two. You can adjust your habits based on the rhythm of your practice so that you can be doing what you need to be doing instead of trying to force yourself into something that doesn't work for you. I will also say it's super helpful to have a separate bank account or a separate credit card for the business. Again, to have that separation and track that income and expenses separately. But I also recognize that that might not work for everyone. Super helpful if it can, definitely considered a best practice, and you know yourself best. So, with that, we know what it takes to run a business, right? We know what some great record keeping practices are. The next logical question is what's deductible for my business? So, when we think about the tax forms, again, we have our Form 1040. And what's reported on Form 1040 is called your net business income. That's the amount of your business income minus business expenses, right? But we want to be able to know a little bit more detail about that number. And that's when Schedule C comes into play. If you are a sole proprietor or the only owner of a limited liability company, an LLC, you will report your business income and your business deductions on Schedule C. If you are a multi-member LLC or a partnership or an S corporation, you will basically report the same information. It's just going to go on Schedule E, probably with a K1 attached instead of Schedule C. But the same types of expenses are deductible no matter what type of business you are running. In general, the business expenses are deductible if they are ordinary, necessary, and effectively connected to your trade or business. And there's a lot of room in these definitions, mostly because there are a lot of different types of businesses out there. So something might be ordinary, which means common and accepted in your industry for the arts, but it might not be ordinary for a different type of industry. And that's okay. It's important that you understand what is common and accepted in your industry, what is ordinary, and what is necessary, which means helpful and appropriate for your trade or business. That's why it's really important to document that business purpose, because you can help sort of explain why something is in fact ordinary, necessary, and effectively connected to your business. So that's kind of the general rule. I will note, though, there are always some exceptions and special rules, but anytime you have a question about whether something is deductible, go back to that general rule. Is it ordinary? Is it necessary? And is it effectively connected to my trade or business? All of those expenses will be reported on Schedule C, and this is an image of what Part 2 of that form looks like. This is generally where we capture the expenses for your business. And there are a number of predefined categories for typical expenses that come up for lots of different types of businesses. Sometimes you might have expenses that fall neatly into some of these categories, and sometimes you might not. That's okay. There is a line called 27A, Other Expenses. And what's nice about this line is it refers you to line 48 on Schedule C. If you find line 48, you will see it is part of Part 5, and that's called Other Expenses. And you can see it's just a bunch of blank lines. If you have a category of expenses that doesn't really fit well into any of these other categories, that's okay. You can define your own category in Part 5 and then report the expense there. That's because this form applies to lots of different types of businesses, not just creative ones, right? So the most important thing is for you to just understand what you need in your business, categorize it in a way that makes sense for you, and then report it consistently year after year. I have often seen some common themes around deductions for different types of creative entrepreneurs. So for visual artists, the most common deductions tend to be related to supplies and materials, or shipping work, or packing it, or delivering it to a gallery or a show or a collector. Those tend to be a lot of the expenses that come up for visual artists. A visual artist will also probably have different subscriptions, maybe advertising related expenses to promote posts on social media or maintain a website. You might also have submission or application fees. You might be paying additional insurance either on your work or on your studio or on different pieces of equipment. You might need to purchase different pieces of equipment, right? Depending on the type of creative practice you have. And you probably are doing some travel. In general, travel is deductible as long as the primary purpose of the trip is business related. The same thing is true for meals. Any meals you have, either while you are away from your tax home and traveling for work, or a meal you have where there is a clear business purpose. So meeting with a gallerist to talk about an upcoming show, or having coffee with a mentor to sort of understand the types of things you should be working on to build up your body of work. There are clear business purposes associated with those meals, and so we would track them as business meals and claim them as deductions. However, your meals are only 50% deductible, 50. You still track the whole amount in your system. Just when we fill out the tax form, we make sure that limitation is applied. I also see a ton of research for visual artists, super common to purchase reference materials or possibly to take research travel trips or even to purchase research materials, so books or attending events or things like that. Just make sure the business purpose is pretty strong, right? We want to make sure there's kind of a clear connection between the item you're purchasing or the activity and the body of work you are creating. For performing artists, we have many of the same types of deductions. So website, submission, application fees, travel, meals, all of those are generally still deductible. Performing artists may also have additional headshot related costs. If you're a musician, you have additional instrument or instrument repair and maintenance type of costs. You might have specific type of supplies related to your instrument, depending on what it is. You might have additional sort of cartage expenses as well. If you're a harpist and you have additional costs to move your harp to various places, that's going to be a very specific cost that comes up for you as a performing artist that might not come up for others as well. But again, many of the same types of things are deductible. I also have client gifts on here. Client gifts can come up for everyone. For our performing artists, sometimes it is an opening night gift or something like that that might come up. Just note that the cap is $25 per recipient for different client gifts. And for literary artists, again, you have many of the same types of deductions and some nuanced ones as well. My literary artists tend to have fewer tangible expenses. So, they spend less on supplies and materials, but they do tend to have a lot of research, a lot of travel, submission costs, memberships, maybe additional fees for folks you may hire. Maybe you hire a social media manager if you are leaning into book talk and sort of getting your work out there. Maybe you hire editors or book designers or other types of folks like that. Maybe you hire a publicist. Maybe you have a traditional publishing company contract, right? But you're going to lean into hiring a publicist as well. All of that could fall under this contract labor category where you are hiring someone else and paying them as a contractor. I will pause here because I imagine we have some additional questions about the types of things that are deductible. Lisa, are there questions we should address at this point?
Yes, we do.
Oh, good.
All right. So our first question, if you started an LLC with a registered agent for privacy concerns, what's the best banking recommendations that understand this and support small online creators?
Oh, great question. Um, I That's a really, really good question. I would be surprised. It sounds like you're getting some pushback from banks if you have a registered agent, which kind of surprises me because that's a pretty common practice. It might be that you might need a larger bank as opposed to a smaller bank. Having said that, I really do like smaller banks and credit unions. I think the account would be certainly in the business name, and the official address would be with the registered agent. You could also probably list yourself on the account as well, depending on the business type you are. But I would say, obviously, if you already have accounts somewhere, sometimes that makes it easier to have a simplified financial relationship. But I would probably start with where you have an account, go from there, and maybe lean into a credit union if you have a relationship there. Or maybe I'm thinking out loud a little bit here, but sometimes an online bank like Ally, for example, is not designed to facilitate business banking. It's designed for personal banking. So I could see you running into some issues there. You might, though, have good luck sort of searching for some business online banks. I'm blanking on one. One of my writers has an S corporation, and she was just hooked up with an online business bank that she really loved. So I'll be happy to follow up and jog my memory to see which one that was. They're all, various shades of good and evil. So I would say start with somewhere where you already have a relationship, just to make sure you can sort of explain the registered agent if they don't get it, and then maybe lean into a business bank if that's some of the pushback you were getting.
Okay. How do you pay yourself once you start business as an LLC?
Ooh, great question. In general, and I will say there are exceptions to this, but in general, as a single member LLC, right, you essentially pay yourself by just transferring money. So an LLC would have its own bank account. We do want that separation if you have that liability protection of being an LLC. So my favorite way to sort of do it takes a little bit of planning and forecasting, but let's pretend you have a gig and you are paid $1,000. You would deposit the $1,000 into the LLC because that's LLC income. And then maybe from budgeting or just experience that about half of what you make goes to the costs associated with running a business. In that case, I want to make sure $500 stays in that LLC account. And then maybe you know that you're going to save about 30% for taxes. I would probably save an extra $300 in that LLC account. And then maybe as part of your forecast or plan, we land on that you're going to pay yourself 20% of whatever you bring into the LLC. Then I would transfer $200 from the LLC account to your personal bank account. I sometimes have folks who will make these transfers every time they are paid, especially if, cash is tight sometimes. I also have folks who will maybe pay themselves quarterly because the income and expenses can fluctuate so much. That is also perfectly fine. But as the owner of an LLC, generally you do not pay yourself a salary where you would need any sort of payroll provider, right? And withhold taxes. It's generally just an owner transfer. So those are often my favorite ways of doing it as an LLC.
Does traveling to an artist talk count as a deduction?
Yeah, absolutely. Right. And so, depending on where the artist talk is, if it's in your own sort of city, right, and you're taking public transportation to get there, you could deduct the public transportation there and back, or you could deduct the mileage if you are driving, plus pay to park or any other tolls or any other expenses you have if you're driving there. That would all generally be deductible. If it is not in your tax home and you have to take a train or a plane or drive a longer distance, that would all be deductible as well. And if it is somewhere where you're required to stay overnight, I would also deduct the lodging as part of that.
Okay. I had a CPA a few weeks ago tell me in 2026, meals, period, will no longer be deductible at all, including meals when I am traveling for work or for my assistant that travels with me. Can you confirm that?
Ooh, I do not know about that change. I feel pretty up to date on all the changes. So there could be something else going on there. They might be subject to additional scrutiny or something like that. But no, as long as there is a business purpose for meals, I think you're still in a good spot, certainly for 2025.
Okay, this is similar. As an artist doing an art exhibition at an entertainment venue which sells alcohol, are my drinks deductible? Under what scenarios are meals slash drinks eligible for deduction?
Yes, definitely. Now, sometimes there's some confusion around this, right? Often that has to do with the reimbursement policies different groups have, right? So if for some reason you are being reimbursed from someone for a meal, they might have a policy that says they do not reimburse for alcohol purchases, right? But if you are at an event and you purchase a drink and it is a social networking event, yeah, as long as there is a business purpose associated with it. And it sounds like the business purpose would be socializing and networking at the artistic event or gallery event where you are showing your work. That feels like a really solid business purpose to me. So yeah, absolutely. With meals, we want to watch out for anything that is considered lavish and extravagant. There's no like magic test for what that number is. But if it's, a cocktail or two, it's probably not going to be lavish or extravagant. If it's like a three-figure cocktail, like you're spending $100 on a cocktail, I think we have a problem. But that might be more than a tax problem, right? So I would say you're probably in pretty good shape there.
Okay, and this is one. I am married and filed jointly. What benefits are there to filing separate when married? Are there situations where one would get more deductions, or is there a reason to file separate?
That's a great question. I would say the general rule is that it's typically better financially and the way the tax brackets shake out to file jointly. Having said that, there are some situations where if one person's adjusted gross income is tied to some sort of benefit. I'm thinking about something like access to subsidized healthcare or something like that, or access to an income-based student loan repayment plan. There could be situations where being married but filing separately could make sense. I will say, though, many things in the tax code are designed to have people or have the calculations basically pretend you're filing jointly to sort of phase out certain deductions. One example is the deduction for interest on your student loans. Maybe you say, oh, I'm going to file separately because partner A has lower income, so they'll be able to deduct more of their student loan interest. Doesn't work that way, right? The deduction is calculated basically using both people's income, right? Because we don't necessarily want there to be financial incentives for making a decision about how to file. So I would say the general rule is that financially, most people are better off essentially paying lower taxes based on the brackets if they're filing jointly. And there are some specific examples where that might be different. If you think you fall into one of those examples, I would say understand what number you're looking at. It is often adjusted gross income. Sometimes it's modified adjusted gross income, which has some extra add backs and subtractions. So be really clear on what you're looking at and really clear on whether it's calculated with reference to both folks' returns or just the one person's return. And then you can play around with the software just to kind of, put in your numbers and try it filing one way or the other. Not that you would actually file, but you can just kind of play around with the settings to see if it makes a big difference for you. Great question.
Okay, and so we're going to hold these remaining questions to the next session because I think Elaine is probably going to go over some of this then.
Fantastic. Thank you, Lisa. Thank you so much for facilitating this. I really appreciate it. So as we sort of wrap up the business portion of the conversation, I'll just reiterate, just pay attention to what you need in your creative practice and make sure you're tracking all of that. We can sort out what is and is not deductible down the road, right? But it's important that you just have a good sense of what it takes to run your business in the way you want to run it. And then I find it really helpful to sort of create a map from sort of what you're calling your categories in your system to where they might show up on your Schedule C. It's a great way to make your tax life easier down the road. Key things to watch out for, make sure you really are running a business, actively pursuing an activity with the intention of making money from it. And also watch for personal expenses that you're trying to disguise as business ones, right? Sometimes this looks like aspirational research. That isn't really research, it's just something fun you want to do. Sometimes it looks like travel. That's really a vacation, but you're just trying to call it a business expense. And sometimes it looks like maybe not really closely following the rules to claim business use of your home. That is a valid deduction, but there are some very specific rules you have to follow about the space being used exclusively and regularly for the business purpose. So just make sure you're sort of honestly approaching some of these things. And then make sure you're keeping good records, right? Save the receipts, save everything in some sort of organized way, right? Document that business purpose, and that'll really help. And then don't forget about your self-employment taxes. As a business owner, you will pay self-employment taxes, essentially your Social Security and Medicare contributions on the profit from your business, right? So that income minus expenses equals that net income from your business. That's the amount you pay self-employment tax on. And it's a pretty big number. It's 15.3%. That covers your Social Security and your Medicare contributions of that net income. So you have to pay this tax before you get any other deductions. You do get your business deductions, but all the other deductions we're going to talk about come after this. So don't forget about that tax. That's the one that often surprises people. One of the next big deductions is the one I mentioned at the very beginning, whose amount changes each year. This is the standard deduction. If you file a Form 1040, you get a standard deduction amount. So if your income is less than this standard deduction amount, you're still paying Social Security and Medicare, but you're not going to pay income tax because this deduction will eliminate all of your income. Or you could choose to itemize your deductions. And you would choose to do that if the things that are listed on Schedule A add up to more than your standard deduction amount. So here we would look at the amount you are paying in state and local taxes. And now we know that cap is $40,000 instead of $10,000. So folks might have a higher number in this category. We would also look at any mortgage interest you are paying on your home. Medical expenses show up here if they exceed a threshold of your adjusted gross income, as do charitable contributions. And there's some other stuff on Schedule A as well, but those tend to be the biggest things and the most common things that show up. So if you are someone that has, say, $12,000 in state and local taxes, and maybe you make an $8,000 deductible charitable contribution, your itemized deductions would total $20,000. If you are a single taxpayer, that is more than your standard deduction amount, so you would choose to itemize. You're going to take the bigger deduction because it reduces your taxable income by more. But what I really want you to remember is that itemizing or taking the standard deduction is an either-or choice. Both of them could go on top of the business deductions. Why? Because your business deductions are captured on a totally separate schedule. You get your business deductions because you are running a business and they are ordinary, necessary, and effectively connected to that business, right? So you get those business deductions and then you choose either the standard deduction or itemizing your deductions. Every once in a while, someone will say that they don't keep track of their business expenses because they don't itemize. And that makes me really sad because if you're running a business, you should be tracking and reporting your business deductions. There's also something called Schedule 1. And Schedule 1 in Part 2 captures what we call adjustments to income. Essentially, these are other deductions that tend to be personal in nature that might give you a little bit of a tax planning opportunity. And if you're keeping track, I think this is the third or fourth schedule we've mentioned. We've had Schedule C for business expenses, or Schedule E if you're a partnership or an S corporation. And we've had Schedule A for itemized deductions. Now we have Schedule 1 to capture the adjustments to your income. So here's what that form looks like, and I want to call out a couple of adjustments that might be relevant for you. The first one is half of your self-employment tax. Because you are running your own business, your Social Security and Medicare contribution is 15.3%-ish, right? You are allowed to deduct half of that. Because if you were working for someone else, your employer would be paying that and they would be deducting it. So this is meant to sort of level the playing field a little bit. It is still a big tax and you still have to pay it, and it can still be very painful. And you get to deduct half of the tax you pay, which helps a little bit. If you are in a position to contribute to a retirement account, that also can be a deductible contribution as long as you're making a traditional contribution, right? So a contribution to a traditional IRA or a solo 401k or SEP IRA or another plan set up through your business. All of those contributions count as deductions to you on Schedule 1, as long as they're under the sort of maximum contribution amounts. If you are someone who is making a Roth IRA contribution, that is also totally fine. You just don't get a deduction for that, right? Essentially, what you're choosing to do is pay tax now on those dollars that you're putting into a Roth, which you might want to do if you're in a relatively low tax bracket. And then those same dollars will be tax-free when you take them out in retirement. If you're getting a deduction for your retirement contributions, that means you will pay taxes on those contributions later when you take them out of your retirement account. If you are someone who is self-employed and you have no access to any other health insurance through an employer or a spouse or anything, then you are able to deduct the premiums on your self-employed health insurance. That shows up as this adjustment to income. And if you have a high deductible health plan, you may also consider opening what's called a health savings account. This kind of works like an IRA in that there is a maximum amount you can contribute to the health savings account each year. Then that amount gets invested and can grow. Or if you're not comfortable investing it, you can park it in essentially like a money market fund. So it'll be earning a relatively high interest rate. The money sits there, it grows, and then anytime you have qualified medical expenses, and the list of what counts is pretty broad, you can reimburse yourself from this health savings account, and those reimbursements are tax-free to you because you spent the money on qualified medical expenses. This requires some record keeping and some extra nuance. So if you're already feeling kind of overwhelmed or you don't have additional dollars to spare, just put this on the back burner for now. But if you're someone who's looking for some extra tax deductions and you have one of those high deductible health plans, this could be a really good option for you, especially if you're going to have some health expenses down the line. Because these expenses don't have to happen in the year of contribution. The dollars just hang out and grow until you're ready to reimburse yourself. And then lastly, there's a deduction on Schedule 1 for interest you are paying on your student loans. It's a relatively small deduction and it does go away as your income goes up. But if you are someone who is paying interest on those student loans, make sure you are claiming that deduction if you're eligible for it. And I know it's still a weird kind of time with student loans with the SAVE plan going away. So I will remind you, studentaid.gov is a really great resource just to make sure you're enrolled in a plan that aligns with what you can afford and what makes sense for you. And also IRS publication 970 talks about the different tax benefits for education, including this deduction. I will also draw your attention to something called the qualified business income deduction. If you've been filing your taxes for a minute, you're probably familiar with this. It generally gets automatically calculated and it is on your main Form 1040. And very roughly, it is 20% of business income from a pass-through entity. So this is a nice little bonus deduction that many artists are able to take advantage of. As part of last year's tax legislation, this deduction became permanent, meaning it won't go away for the foreseeable future, which is nice. And then again, all those new deductions that were introduced last year are going to be captured on that new form Schedule 1A. So be patient with yourself and anyone else as they are navigating this. All of these were introduced last summer. And so the year had already started before a lot of folks knew they needed to be sort of paying attention and calculating this stuff. So go easy with yourself as you navigate some of the newness. All right. So what we've done is we've reported all of our income, including business income after deductions. We've reduced that income by adjustments and the standard deduction, and we've gotten to essentially our taxable income number. Then we calculate the tax. And as I mentioned, we have this progressive tax rate system where the rate goes up as the taxable income goes up. So everyone will pay 10% in tax on the first 12-ish thousand dollars of taxable income. And then you'll pay 12% in income tax on the next, what is this, 36-ish thousand dollars of taxable income. And then you'll pay 22% on the next 52-ish thousand dollars of taxable income. And what I will say is, as you're looking at your income for the year, especially if you have income from a lot of different sources, make sure you're kind of paying attention to where you might land, right? Because this 12% to 22% is a big jump in the tax rate. And if you are someone who has several jobs, all of which are paying you, $20,000 or $30,000, When you combine them all, you might find yourself in a slightly higher tax bracket at the end of the year, and that might mean you owe additional money in taxes. So you don't have to perfectly model this, but if you just kind of have an awareness of where you're going to land, then you can be less surprised when tax season comes around. And also, just a reminder, this is just the income tax, right? You have already paid self-employment tax, that Social Security and Medicare, on this number up here. So this tax is in addition to that tax. And then, of course, after you do your federal taxes, you probably have to do a state tax return as well, depending on where you live. There are a handful of states without an income tax, but there are many more that do have one. So in general, your adjusted gross income tends to be the starting point for your state tax return. And if you are someone who has earned money in multiple states, you might also find yourself filing tax returns for multiple states. The general approach is to kind of figure out where you earned money and what expenses, if any, are associated with those states, and then figure out if you have a filing requirement in those states based often on how much you earned or how long you were there as a non-resident, and then file those states and then file your home state last, because then you can claim any credits for taxes you had to pay to other states. Once you know your total tax amount based on the actual real income and expenses you had throughout the year, we figure out that tax number and then we compare it to what you paid in during the year, either through quarterly estimated tax payments, if you're making those, or through withholdings from a W-2 job you might have. We compare those two numbers, and if you paid in too much, you get a refund. If you did not pay enough, you will owe an additional amount in tax. And if you owe more than $1,000, you will probably pay a small penalty, and it's a really good time to start making estimated payments for that next year, or maybe to update the W-4 you have on file with your employer and ask them to withhold a little bit extra. As you're going through all of this, and especially thinking about what's coming up this year, I'd encourage you, if you're going to have self-employment income, go ahead and save 30% of what you earn in your business, right? As I mentioned, you can adjust the W-4 if you have a job through an employer and ask them to withhold a little bit extra. But sometimes it's easier, especially if most of your income is coming from your business, just proactively save about 30%. 30% might be more than you need, but I don't hate that as a strategy, especially if you are someone who tends to spend dollars that are there. If you proactively save that 30%, then if you have a little bit of extra at the end of the year, you can put it into a retirement account or something else that could be nice. If you want a slightly more nuanced calculation, you can work with a CPA or a tax preparer, or even look at your own tax return for 2025 once you've finished it to really understand what your own effective tax rate is, right? 30% is a good general rule that often covers what you need, but your situation might be very different. So if you look at the total tax number you have on your tax return, and you divide it by the total income you have, that'll give you a general sense of what your effective tax rate is. And that could be a good starting point for choosing what to save going forward, or even what to pay into those quarterly payments if you're going to start doing that. You could also work with someone to do this calculation or be very proactive about sort of monitoring your income and expenses throughout the year and keeping track of that savings. I also have, I call it the tax estimator tool. It really is just an estimator, but if you want to get a rough sense of what your taxes might be for a lot of different situations, it's not a terrible starting point. The IRS has one as well. It is very detailed and very accurate, and it will take you a long time to work through. This option is less detailed, right? It's a rougher estimate, but it will put you in the ballpark. And I will note if you find yourself in this Google Sheet, we have options for the 2025 tax year and then also updated numbers for the 2026 tax year. So make sure you are paying attention to the name of the tab so that you can pay attention to what year you're estimating your taxes for. But this basically allows you to roughly estimate your business income and expenses, including any other W-2 income or other income you might have. It lets you change your filing status and your entity type, plus your state location and whether or not you have high, medium, or low city taxes. Again, it's a rough estimate. It is not meant to be perfect, but if you're looking for a good estimate or a percentage to make decisions based on, this could be a good place to go. Okay, Lisa, what did we miss? Are there other questions that have come through?
There are. So, if you are traveling semi-frequently and or abroad, any advice for sustainability?
What a beautiful question. There are some like carbon offset programs you can participate in that can sort of help offset some of the impact of your travel. You could also sort of set up your own internal carbon offset equivalent type of program where you basically intentionally make, say, charitable contributions or other sort of environmental financial actions you might take to sort of support your own sustainability. I would also say just continue paying attention to some of the conversation in the world around as efficient as you can make that travel, including, sort of bundling trips to maybe cut down on flights or, I mean, that's not always possible. But if there are ways for you to kind of explore that, that feels like a lovely conversation for you to participate in and a lovely thing to be aware of.
Are there best practices for payment within LLCs with partnerships slash multi-member?
Ooh, great question. You can follow the similar process to a single member LLC, and that's totally fine. You can also explore sort of guaranteed payment amounts with your fellow LLC owners. There can be some nuances there that help. Often, depending on how big the LLC is and how many folks are involved, sometimes towards the end of the year, LLCs will make distributions to help cover the taxes that their multi-members are going to pay. So you can think about that as well. But yeah, few more options, but also generally some of the same approaches. And I should say, any type of LLC could elect to be taxed as an S corporation, in which case you would then make salary payments to the owners. Again, with a lot of flexibility around what those amounts look like and when they might be paid, but that could be a good option as well.
If I have a 401k that I set up with a previous employer, can I add it? Can I add to it at the end of the year as a self-employed person now to keep my annual income from going over what I had predicted for something like the healthcare marketplace subsidy, as my fourth quarter is usually my best, but you never know, so it's hard to adjust for unusually large quarters so late.
Yeah. Oh gosh, that's such a tough situation. I'm so sorry. The short answer is no. If you are no longer employed by that company, you usually cannot contribute to that 401k because usually all of their contributions have to be made through payroll deductions. And if you're no longer getting payroll, you can't contribute. But here are some options. One option is you could roll that old 401k over into a new retirement account, and you could make an IRA contribution up until tax day. So if you are under the age of 50, you could put in an extra $7,000 to a traditional IRA. This 401k is probably traditionally set up. So that would give you a $7,000 tax deduction. Or you could say, I want to leave that guy hanging out. I just want to open my new IRA and contribute $7,000. So those could be options. If it's your own IRA, either rolled into or a new one you're starting, then you can make contributions as long as you have earned income. Um, if you say to me, Elaine, $7,000 is not going to get me there, I would say there are some extra options for self-employed retirement plans. So there's one called a SEP IRA, SEP IRA. And in general, the contribution limit to a SEP IRA is 20%-ish of your net business income. So let's pretend you're going through the year, fourth quarter is the best. You technically have until tax day to make that contribution to the SEP IRA from your business, and that counts as a deduction on your personal tax return. So if you had a really good year, let's pretend you had, $100,000 in taxable income, that could get you like a $20,000-ish tax deduction for that contribution. The calculation is net business income minus half of your self-employment taxes times 20%. So 20% is a good-ish number. But so that could be one way, a SEP IRA, and those contributions can be made until tax day because they hinge on what the taxable income was for the year. The other option is setting up what's called a solo 401k through your own business. And this would be essentially like a 401k you would set up for yourself. And what's nice about the 401k is there are two different ways to make contributions. The first way is just like the SEP, right? 20% of the net business income can go into the solo 401k, which is great. The second way is through essentially something called an elective deferral, which is more like the payroll withholdings from your old job. And that could be up to $23,500. Usually, the elective deferral has to be in by 12/31. The business does have some flexibility to make that sort of matching contribution up until tax day. But if you're a sole proprietor or a single member LLC, I have seen some exceptions to that elective deferral 12/31 hard deadline. I would just say, be careful with it. So hopefully some of those options will point you in the right direction. Having a SEP or a solo 401k is probably not something you want to administer yourself. You want to go through a brokerage firm or some sort of retirement planning person to make sure the plans comply with all the tax laws and then sort of do what you need them to do. So I hope that helps. And congratulations on a really great fourth quarter, but I'm sorry it put you in that position.
Okay, and now we just have some wrap up. Thanks, this is awesome. Thank you. I've been using Airtable so far, but I like this. Michael, the link to all the templates will actually be you all are going to get these slides, and so you'll be able to get the links from the slides. So no worries. Very interesting. This makes perfect sense. This form is amazing. Wow, thank you so much. And that's everything.
Amazing. Oh my gosh. Well, thank you for shepherding all of those thoughts and bringing them forward. Here is a quick recap of those key tax questions we answered with very short TLDR answers and a quick reminder of what we did today. And I will just end with gratitude. Thank you all for being here, for being so engaged and asking so many wonderful questions. Thank you to Lisa and the entire South Arts team for all you do day in and day out to support creative individuals in pursuing what they do really, really well. And thanks to you all for continuing to do the creative work you do. It is so important. So happy tax season. See you soon.
All right. Thanks everyone for being here. Don't forget to fill out the survey. We put the link in the chat. And as always, if we can help you, reach out to us at South Arts. And again, happy tax season. Bye. Okay. Helena,
I'm here.
I never know if, but I think wait, there's still other attendees.
That's right. Thank you so much, everyone, for attending. We are requesting you say goodbye for today. Let me see if I can. All right. Thank you all so much. All
All
right.
right.
We're clear. Sorry about that, guys. What a wonderful webinar.
Yes, I learned something new every time we do this, Elaine.
I know, and my
Oh, I'm
husband,
so glad. And thank you so much for the kind words. I'm glad you both enjoyed it.
my husband was walking by. He literally stopped and started taking notes.
That brings me so much joy.
Well, we'll make sure he gets the slides as well. We're going to share.
Totally.
Absolutely.
Yes,
Absolutely.
we share them liberally. Oh, that's
All right.
hilarious. I
Thanks
love
again,
it.
Elaine. You will definitely be on our calendar for next year. If I could book you today, I would, but I don't know if you have your availability that far in advance. But just know you'll be back next year for our annual tax basics for creatives.
I can't wait. I imagine we will have new things to talk about next year. And if you want to send me some dates, I have no problem reserving the time for you now.
Same time next year.
You got it. Thanks,
All
Lisa. Thanks, Alina. I'll see you next time.
right.
Bye,
Thanks.
Lane. Thank you.
Bye.
Thank you. Bye.